Welcome to the Beyond the Deal podcast. I'm your host, Michael Wagman, and I am obsessed with personal growth and success. In this podcast, I interview extremely successful people, and sure, we're going to talk about deals, we're going to talk about numbers, but we also want to go deeper than that, and we want to get to the habits, the tips, the tricks, the things that lead to success in life and business. Now, before we get started, I do want to thank the sponsors of the show. That's me. I sponsor this show. Nimble Capital Group is my company. We are a private investment firm offering options to passive investors who are interested in equity appreciation, tax depreciation, and cash flowing assets. Secondly, if you are interested in learning how to raise capital, I am taking on 10 students every single month. I have a couple of spots open still this month. So if you are interested in learning how to do what I do, then please reach out. See the show notes in the description below. My guest today is Litan Yahav. Litan is a 2X tech founder who has had a successful exit, and he talks a lot about how to balance life and stress as a successful entrepreneur. So let's get right into it. Litan Yahav, welcome to Beyond the Deal podcast. How are you doing today?
I'm good, man. I'm excited. Congrats on the new show.
Thanks so much. Thanks for being here. You and I have been friends for quite a while now. I think it's probably coming up on 3 years already since, we've known each other. And in that time, we've shared a lot of cool things together. Particularly our trip through Israel a couple of years ago was one of my highlights of my life. And could get into a little bit of how we know each other. But first, why don't you tell the audience sort of what is your background and what are you doing today?
Yeah, sure. First of all, I love it that 3 years is a lot. I think it's the experience we've been through is like what makes it a deeper friendship. But yeah, we can dive into that. So some background. I'm 42, married, I have 3 kids, born in the States, moved to Israel when I was 9 years old on a whim of my parents. Served in the Israeli military for 6 years, the school in Israel, and then founded a company in a crazy diamond industry where we did 3D imagery for diamonds, hardware and software, crazy little business. It went well, scaled, exited it in 2015, and just been investing since then passively in a lot of real estate, private equity stuff. And then about 5 years ago, me and my co-founder decided to build a new company to manage our own wealth, and it turned out to be a startup that we raised money for, and I'm full-time into that. So that's like a quick background.
Yeah, I think you bring a very unique perspective too, because I think a lot of my listeners are some combination of active and passive in the real estate world, but I think you bring the passive perspective as somebody who's been in quite a few deals and actually was so influenced by it that you had to create a whole new company to manage all the chaos of being invested in all these different deals, right? But I want to go back a little bit. So you had an exit, or like an actual successful exit. Can you talk to us a little about the psychology of what that was like and leading up to it and post how it all felt?
Sure. So this is a company we founded in 2012 and the exit was in 2015. So it's a pretty quick exit in startup world life and not the conventional type of exit. So, I mean, everyone thinks that they had a unique journey. At least that's the way I see it. And so like the company we started was in a very niche industry. We raised capital for it and sold it. We didn't make tens of millions in the deal, but while we were scaling this company, we had an offer from actually one of our investors to buy us out and become fully owned by them. And it was this whole back and forth negotiation, also internal process. Should we take this? Should we raise some more funding and grow bigger? And at some point we just decided, hey, I mean, the exit is like a cash and equity deal. And so we received equity in the acquirer, and we believed that the combination of those two can make us bigger than what we were at that point. And so that's why we went down that rabbit hole of selling the entire company to them. And it was a really good deal from a structural standpoint, because many times when you exit a company, a startup, the outcome of that is miserable for many founders, because you become a part of this larger organization, going through corporate world of authorization and different types of bureaucracies that you don't have as a startup founder. And for us, it was more, hey, we're just becoming the owner of all of your shares, but you're still the CEO and you're still calling the shots. And at the end of the month, instead of like dealing and thinking about how do you raise more money, you just send an email to us and we'll, based on the budget you put together, we'll just transfer more money. And so we were really an autonomous subsidiary, life really easy for us. And so it wasn't this acquisition where, cursed everyone for 2 years, which is what happens to a lot of founders who sell their companies and are absorbed by the parent company. A few like miserable earnout years. And just to clarify, an earnout, when you sell a company, many times the acquirer will demand an earnout period, whereas you're still committed to the parent company amount of time, and you only receive the entire compensation for the acquisition as long as you stay in for that amount of time. So for us, it was an easy call because it was basically doing the same thing, only with a big account behind us.
So for you, the transition wasn't so stark. In fact, it was barely noticed, and you just had a lot more money at the end of it. Is that right?
I mean, pretty much. I mean, it wasn't 100% the same. Like we stopped acting as a company that needs to prove and grow the business side of it. We became more an operational side of the business. So we built technology to photograph and display diamonds in 3D online. So instead of charging for it from our customers, became this aspect of the parent company to go and process diamonds for their customers around the world. And so we just set up more and more branches. So it became really operational, not business development, like biz dev, sales, and marketing, which is it's just a different animal. Personally, I don't think it's as interesting, but it was still very comfortable.
So post-exit, tell us a little bit about, you've invested now in multiple deals as LPs. What kind of deals were you investing in? What kind of deals do you like now? And talk us through the creation of your current company.
Yeah. So, you get this liquidation event and now it's like, oh shit, what now? This good big question that, I have some money. What do I do with it? And I always tell the story because as Israelis, it is very common to invest with people in passive, like private equity, real estate deals, because everyone does real estate abroad. And so we knew we wanted to get into real estate. We didn't know exactly which and how. We just started to deploy some checks. Some of them went into active deals, buying actual single family homes, long-term rental properties, and some of them went into real estate syndications as LPs. This was 2015, 2016. So this is like the golden age of syndication. Anyway, so we started to deploy capital and we saw that these active long-term rentals just became a total pain in the ass in terms of managing it and communicating with municipalities and tenants and property managers. And these passive LP deals were like, wow, this is amazing. It's generating better returns. There's no ongoing effort, only on the front end and finding people you can trust. But then once you find them, it's essentially smooth sailing from an operational step. You don't have to do anything. And so at some point we got rid of those single family homes. We just doubled down on syndication and LP investing, finding obviously people we can trust to invest with, have a good track record that aren't big enough to send us deals every week, but big enough to have deals, a few times a year. And so we built a portfolio of those types of investments. And at some point, probably 5 years ago, it became a mess. Like I'd get an email from one of these syndicators, GPs, and have this good problem of saying, holy shit, who's this person and when did we invest with them? It's a very good problem to have, but it's a problem you have when you have multiple of these holdings. And again, when you own Apple and Google and whatever, Tesla and all these publicly traded companies, it's pretty easy to concentrate everything in one place with all these aggregators and platforms. But once you add a mix of private investments, active or passive, it doesn't matter. Once they're private, they're not syncable. It's really hard to understand the data. You're bombarded with emails and documentation, not to mention tax documents and K1s. It just became a mess, and that's sort of what led to Vyzer.
Okay. And so it's my understanding that Vyzer is sort of an all-in-one tool for wealth management, right? It allows you to track how your investments are doing across, different LP investments and stock portfolio and, net worth and everything like that. But why don't you elucidate me a little bit about what you're doing today?
Yeah, sure. So essentially, and the backstory of this is we didn't make enough money where it made sense for us to have a family office, which is usually something that big people with a lot of money have. But we started to experience the problems and issues that people at that level have. And I'm mentioning that because from the product side of our business, it's sort of we want to give the same type of approach that at least from an administrative standpoint, a family office provides. So no matter where our investments are, through API or on a portal that cannot be synced or in my email and documents, we want to be able to pull everything from everywhere and create a single financial source of truth based on all that information. And to create in a way where you don't have to work hard on doing it. Now that's a constant challenge that we're dealing with. How do we lower the effort to pull data in from everywhere? A lot of tech and AI into it, of course. And then while doing so, how do we give insights and recommendations based on that data? And so, fast forward 4 years since we founded the company, we're currently tracking almost $10 billion of assets. And we don't just have the ability to pull data in and analyze it. We now have this huge data set, which is predominantly in the private markets of where people are investing, how they're investing, who the good players are in the market, who the bad ones are. And now we're tapping into that. We're not just providing administrative aspects, but providing access to great deal flow as well.
So that's a perfect segue to what I want to talk about next, which is you as somebody who has access to a ton of real estate data. What do you think is going on right now? Where are we in the market cycle and what do things look like? Is it really a bloodbath? Is it as bad as it seems?
Yeah, so it's not just real estate. Just when I say private, it's obviously it's funny. Everyone is pulled to where they live, right? Yeah, so we just had a webinar and we were talking about capital calls. And capital calls as a term in private equity can either be seen as a good thing or a bad thing. It's crazy. If you talk about real estate investors and you tell them capital call, they turn like green. Like, I don't want, why are you cursing and telling me bad words? If you talk to like a proper private equity investor and there's a capital call, like, yes, capital is finally being called so it can be invested because they committed to this fund a year ago, but they haven't called the capital yet. I finally want to deploy it. And so it's like these two. So when you say privates, yeah, we see trends across the board. I will say, and this is not new to anyone, I assume, but since the zero interest era collapsed, you did see obviously less activity in the private real estate markets from an LP perspective. Obviously, across the board, also from GP and active real estate investors. It's been harder to pencil in deals because of interest rates and uncertainty in prices and people not selling. Just a lot of like really weird stuff, and an increase in private credit across the board, just because it becomes a more attractive market, better returns. And when you can achieve at a zero risk 5-6%, annualized returns with just having the money in the bank, it's really hard to convince people to invest in a real estate deal that's maybe performing a bit above that and has upside.
6, 7, but certainly not in year one, right?
So you've seen that. There's also been the whole world of search funds, which there was this big peak of hype and then drop because it doesn't really work. There's a whole.
You're gonna have to tell me what that is. I've never heard of search funds.
So a search fund is basically people would hire or raise capital to invest in a searcher, say an MBA graduate, okay, who commits to finding a business they can buy and flip. And a search fund would fund that person to go find those businesses and then also flip it. So that person would get a salary to go find a good fund or a good business to buy. They get more money from that fund to flip it. So that's a search fund. Because another asset class that was on the rise is buying cash flowing businesses.
On the rise, yeah.
It still is, yeah. I mean, people want to buy businesses that cash flow. Now, by the way, a multifamily value add deal is a business that cash flows. It's just highly leveraged, which makes it a profitable business. A lot of mom and pop type shops aren't leveraged. They're just a good business without that leverage. And so you'll go and you'll buy a landscaping business or a street cleaning business or a car wash or whatever these cash flowing businesses. They're usually not really levered, and then you can implement because they're just like mom and pop shops. And so it's a different type of business model than a multifamily value add type deal, and that has been attractive as well. So you've seen an increase in that. And of course, there are still sponsors and operators that are raising for private equity, real estate, multifamily stuff. I just think it's less.
Yeah, I think we're in a different phase of the market cycle for sure. There was a period there in the 2020 to 2022 where it seemed like nobody could do wrong, right? It was like people bought deals with a 5-year projection, ended up flipping them 18 months later for a 2x, for a 3x or whatever. And they looked like absolute geniuses, right? But timing is everything. And this is not that time. Yeah. So very interesting to sort of hear your insights on all the data that you've collected. I would like to actually turn it around a little bit on this podcast. We really try to step away from the numbers and the real estate and the, all that kind of stuff and talk a little bit about sort of psychology and mindset and success. So you are basically a 2-time tech founder at this point, I guess I could say, right? A 2x tech founder who raises capital through venture, right? What is that like? What is the stress of being a venture capital founder like in today's environment?
Yeah, I mean, I think it's such an important and interesting topic because I think people don't understand the roller coaster that people go through as a tech founder. It's not a roller coaster that's like on a daily or weekly. It's on an hourly basis. Like you can have a day where you can be extremely up and extremely down during the whole, it's crazy, right? The stress levels of it. My previous company I didn't have kids. And this one I have kids. And so it's a different dynamic as well. Because, people also see the good. It's funny. I think we have this in GoBundance, and which we're part of. Show like the craziness people went through to generate their net worth. Because everyone thinks, oh, it was a quick success, but they don't see all the craziness and shit you go through to achieve it. And I'll be honest, even me, knowing that it's really hard and difficult and constant up and downs, still see those who are like really successful. It's like it's hard not to look to the side and say, damn, it looks so easy when they do it, right?
Yeah.
So yeah, there's definitely a lot of stress and challenges, but this is the crazy truth. I think entrepreneurs by definition are attracted to that because we need it.
Yeah.
Because it's what makes our lives a little more interesting. It makes our better parts or partners or spouses or wives, whatever, to deal with that. My wife, we've been together for a long time and she, I don't think she can imagine me doing anything other than this. Like if I weren't weren't stressed out and working my ass off, I don't know. I think she might be worried.
True. There is a feeling, I think that every entrepreneur is very familiar with, of just like lying awake at night because there are thousands of things that you probably should be doing or thinking about or optimizing or whatever, and sleep becomes much less of a priority or much harder target to achieve. When your life is simpler, you just go to bed at night, you wake up, you go to work, you work your 8 hours, and then you go home, and then you leave your work at home, right? And it's never like that again as you step into the road of entrepreneurship.
Yeah. I will add one thing. I mean, there's a whole notion of that I love and I believe in entirely, which is you want to live your life being as much as possible out of your comfort zone. And I think being out of your comfort zone, or me being out of my comfort zone, I've sort of found that that's what I'm excited about. So whenever I'm stressed, I'm like, this is that opportunity for me to be out of my comfort zone and to learn and deal and grow from it. I think that's been extremely fundamental in the way I've been dealing with this type of bad stress, trying to convert it into good stress.
Yeah, you can use it to fuel you, right? So it doesn't have to be everything is stressful, so I'm going to collapse. It's everything is stressful, so now I'm focused and I can put it where I need it to go. And I certainly relate to that heavily. So you mentioned that, when you had your first company, you had no kids. Now you're a father of 3, am I right? 3 children?
3 little crazy boys, yep.
3 little crazy boys, right? And you've just recently moved back to the US from Israel, right? So how are you sort of prioritizing your time these days? How are you sort of managing that stress that we've been talking about and spending time with the family and being a tech founder?
So first of all, I have an amazing wife who's extremely supportive, and you give that space. But it's really been like also important for me to be as around as possible for my kids, even if it's an account of me working harder. So, in the evening, I'll try to be with them, probably from 5, 6, but then I'll get back to work after their sleep, wake up early in the morning, work in, and also try to work out just because that's also important. I don't do enough of it, but I really want to. And, just like, unfortunately, because of that, I had to prioritize. Like, I remember I was supposed to go play poker like the other night, and I was like, no, I wanted to stay home with my kids and watch a movie. And so I missed out on being with friends, but I'm totally happy with it because those are the moments that I'm going to regret not spending enough of in the future if I don't. And also I work from home. So it's also, I'm more at home with the kids than I am now than I was back in Israel, but it's also a lot more distracting. So it's like that constant balance between the two.
All right. So before we sort of take off here, I have a couple more questions. Do you have any podcasts or books or things to recommend that have really been influential on your life and how you live it?
Yeah. So from a book perspective, I mean, there's so many, but I always go back to Never Split the Difference by Chris Voss, which is all about negotiation. And I think that's such a key part of our lives, not just as business people, but also as parents and friends and even going to the store or whatever. I think negotiation skills are so important. And so I'd say that. Podcasts, I mean, it's hard for me not to give the common ones. I'm a huge fan of the All In podcast. Some episodes of Joe Rogan I like, even though I feel like they're a little long form. I just gotten in something that I should have gotten in a while ago to Lex Friedman, which I also think is really interesting. My objective is to try and, absorb as many insights and knowledge from different perspectives as I can. I think those 3 are all about the same, but I also want to find another perspective. But I don't drive enough anymore to listen to podcasts. And so it's like, I need to find the time to do it.
It's funny you mentioned that. I recently started going to the office, which we did not have an office for a long time. Now we have an office. So that's about a 30-minute drive that I do multiple times per week, back and forth. And that's when I listen to my podcasts. It is such an invaluable time to me to use for knowledge. And I'm a musician, as anybody who can see my background would know, and I'm not really listening to music anymore. I'm just trying to get smarter all the time. So I love that and agree with it fully. Are you doing anything? I know you mentioned that sometimes you work out in the morning, sometimes you just work in the morning. Do you have a routine that you're trying to stick to as far as like a morning routine or a nighttime routine, something that sort of gives your day structure as an entrepreneur?
Yeah, I mean, I've been playing and tweaking this, but I feel like cold showers every morning are like a really key part of my day. I don't have a cold plunge or anything, but it's the closest I get to it. And I live outside of DC, so it's freaking cold here. So that's been helpful. I journal every day, but when I say journal, for me, it's writing my highs and lows for the day, every day. And just from a routine perspective, I really try to track my habits and goals that I set for the day. If it's, breathing exercises or working out or eating healthy, like those have been things that I've been tracking and very intentional about.
How are you tracking those?
I use this app called Habit Share. It's really free. easy, intuitive app. It's cool because whenever I mark that I did something, friends of mine on the app get notified, and when they do something, I get notified, and so it reminds me to do my habits.
All right. Well, that's, I think, a great tip for our listeners, is sort of a social backing way to hold yourself accountable, right? Cool. Well, I don't have any more questions, Litan. It's been excellent having you here. Can you tell our listeners a little bit more about where they can find out about Vyzer, about you, how they can reach you?
Yeah, sure. So it's Litan Yahav. It's a weird name, but it's pretty straightforward written. It's Litan at Vyzer.co, Vyzer.co, or just, I'm on social media everywhere. Litan Yahav. Happy to talk with anyone interested.
Thanks so much for being here.
Thanks for having me, bud.
That's a wrap for today's episode of Beyond the Deal. I hope you got some valuable insights that you can apply to your own investing journey. Now, if you've enjoyed this conversation, do me a favor, hit that follow button, leave a review, and share this episode with somebody who you think could benefit from it. It really helps the show grow and bring on even more incredible guests. If you want to go deeper, make sure to follow me on your socials. You can find the links in the show notes in the description below. Thanks for tuning in, and I'll catch you next time. Until then, keep going beyond the deal.